Have you ever really wondered what separates a professional trader from, well, a gambler? I'll give you a hint. It's not some magic crystal ball. It's a rule book. And today, we're going to crack open a real pro's playbook and see the strict, systematic discipline that powers their decisions. Let's dive in.
So let's just ask the question straight up. What is the real difference? I mean, they're both putting money on the line, hoping to make more, right? But the gap between how they operate is just massive. And that's exactly what we're going to break down. Okay, let's get the biggest myth in trading out of the way right now. Professional traders have absolutely no idea what's going to happen next. They don't know if their next trade is going to be a winner or a loser. And you know what the crazy part is? They don't really care. So why doesn't it matter to them? Because their secret weapon isn't prediction, it's probability. It's all about having a rigid, battle-tested system, a rule book that takes all the emotion, all the guesswork, and all the hope right out of the equation.
The system we're about to walk through comes from a real-life rulebook for trading micro NASDAQ futures, the MNQ. It's basically a way to trade the direction of the top 100 tech stocks. So this isn't some abstract theory. These are the exact practical rules one trader lives by day in and day out.
Every great system, whether it's in trading, sports, or business, starts with a really simple, powerful idea. It's the foundation everything else is built on. So what's the core philosophy driving this entire playbook? It's this simple. The whole game is not about catching every little wiggle the market makes. Nope. The goal is to identify a key zone, wait patiently for the price to arrive, and then trade it to the next key zone. That's it, from one zone to the next. And these key zones? They have a name. They're called areas of interest, or AOIs for short. But the key word here, the one that changes everything, is zone. We're not talking about a single perfect price point. Think of it more like a battleground, an area where you expect a fight between buyers and sellers to break out. So you're at the battleground. How do you know which side to bet on? Well, that's where the gatekeeper comes in. It's called the higher time frame bias. Think of it as the big, overarching trend. If the market is generally heading up, you are only allowed to look for buys, period. If it's heading down, you're only looking for sells. Trying to swim against that current? It's just not allowed. The gatekeeper says no. All right, so the philosophy is crystal clear. Find a zone, make sure you're trading with the main trend, and go from one zone to the next. Now let's get into the nitty-gritty. How does that turn into an actual clickable trade? This trader never, ever just jumps into a trade. They use what's called a two-candle model. The first candle shows up at the battleground, at the AOI, and that creates the idea for a trade. But that's all it is. It's the second candle, the confirmation candle, that acts as the trigger. No confirmation, no trade. It's that simple. And this is just a perfect example of that discipline. To even think about taking a top-tier A+ trade, every single one of these boxes has to be ticked. You have to be at the right location, you have to be going in the right direction, and you have to get the green light from that confirmation candle. If one is missing, you just walk away.
So what does that confirmation candle actually look like? Well, the rulebook is super specific. If price has been falling down into your zone and you're looking to buy, you need to see a candle that closes decisively up, pushing back against that downward momentum. It's the market literally showing you its hand.
Okay, we know how to find a trade and how to enter it, but this next part, this is arguably the most important section in the entire playbook because this is all about defense. These are the rules designed to protect your money and your sanity. Rule number 1, and it's non-negotiable. No single trade, I don't care how perfect it looks, is allowed to risk more than $200. That is the hard ceiling. This one rule prevents a single bad decision from blowing up an entire account. Next up, you only get 3 shots a day. That's it, 3 trades. This forces you to be incredibly selective. But more importantly, it stops you from revenge trading, that emotional spiral where you keep jumping back in, trying to win back what you lost. 3 strikes, and you're out for the day. And this is the ultimate circuit breaker. If at any point during the day the account is down $500, a kill switch gets flipped. The computer gets turned off, trading is over, end of story. It's a way of admitting that some days you just don't have it, and the smartest thing to do is stop the bleeding. Now, I love this rule because it's so psychologically smart. If you take 2 losses in a row, the playbook says you're probably not seeing the market clearly, so you have to cut your size way down for any other trades. It's a built-in mechanism to protect you from yourself when you're most vulnerable.
So you've followed all the rules, you're in a great trade, it's moving in your favor. Now what? See, getting in is only half the battle. A true pro's rulebook is just as specific about how to get out. The exit strategy is called the partial and runner model. It's pretty cool. Once the trade hits its first profit target, the trader sells off a big chunk of their position, say 60%, to lock in a guaranteed win. The other 40%, that gets to run, just in case the move turns into a home run. And here's the magic move. The moment that first bit of profit is banked, the stop loss for the rest of the position gets moved right to the entry price. This creates what they call a risk-free trade. Now, the absolute worst thing that can happen is you break even. You can't lose money anymore. It's a huge psychological relief. But what about that runner part? How do you manage it without letting greed or fear take over? You guessed it, there's another checklist for that. While the trade is live, the trader is constantly asking a series of simple, objective questions. They run through these 4 questions over and over. Has a partial been taken? Yes. Has risk been reduced? Yes. Is the market structure still holding up? And is that main trend, the HTF bias, still the same? If the answer to 2 or more of those questions suddenly becomes no, the trade is over. You exit immediately. It's a brilliant way to make unemotional decisions in real time. And really, this one quote sums up the entire philosophy of managing a trade. The number one job is not to squeeze every last drop of profit out of a move. The number one job is to protect your capital. Getting out safely is always, always more important than getting out perfectly. So as we can see, a pro trader's edge isn't some kind of magic. It is a relentless, almost robotic commitment to a system, a process, which kind of leaves us with one final thought, right? This level of discipline clearly works in the markets, but where else in your life could a system, a personal rulebook like this, give you an undeniable edge?